time for Lykken on Lending.
Welcome, everybody. Good to have you with us.
Welcome to Lykken on Lending, a weekly mortgage market update providing up-to-the-minute information on interest rates, loan programs, and hot industry news, all related to the mortgage industry. Brought to you by Transformational Mortgage Solutions. To participate in today's program, our guest call-in line is 646-716-4972. Now here's your host of Lykken on Lending, David Lykken.
Let's begin.
Listeners, we got another special podcast for you. We've got someone talking about the markets. They're experts in creating products, software products specifically to help you on the pricing side as well as the underwriting side. So we're really excited to invite Dawar. And how do we pronounce your last name again, Dawar? I want to make sure we have that right.
Yeah, it's Alimi.
Alimi. Is that right?
Alimi, yeah.
Alimi. Okay, there we go.
enough.
Alimi. Very good. Very good. We'll clean that up in the edit. As well as we got Paul Orlando. That's a good American name there, Paul. So I can get that one right. I always slaughter a name, so it's terrible sometimes what we go. Anyway, joining me on the podcast, listeners, is Mark Helm. Good to have you, Mark. Appreciate you as my co-host being here and helping with this interview.
Glad to be here, David. Thank you.
Good. Well, Dawar, I met a number of years ago when he first launched Lender Price, and I was so impressed with what he was doing back then. I've been looking for an opportunity to have him on the podcast, and we have it today. And also joining us is Paul, and Paul has got 36 years of mortgage IT experience in operations and applications development and data warehousing, a lot of technology in there. Also is cost accounting, budgeting. Boy, I tell you, cost accounting, I look at that right now, Paul, where our mortgage industry is at. And we need a lot hear all of your wisdom you have for us. So looking forward to getting into it. But before we get started, Dawar, let's start with you and give us a little insights into your journey to where you're at, what's brought you to the place you're at today.
I've been in the mortgage industry since 2001. Never thought I'd be in it. I think that if you ask a lot of folks out there, like, how did you get here? You just kind of stumble across and end up here. But I love the industry. I'm a software engineer. I've got an undergrad and graduate degree in it. But I've also owned a mortgage company, and I've been in mortgages. I've originated loans, but primarily been on the software side of things.
Well, I never forget meeting you because we met in Boston, and you were at, were you launching at that Boston conference, or had you already been up and running for a while?
Yeah, we were. That was our first MBA conference ever. And it was a fantastic event.
Well, and you were a bit overshadowed by one of your investors. Kevin Costner is one of your investors in the company. I'll never forget that. David Kittle was there. And I mean, we couldn't get around you guys. It was, Kevin was just smothered. So that's the problem with having a celebrity investor. You show up and they go, no, what company you guys have here? I thought that was hilarious, but it was really fun to hear the vision of what you had. I'm looking forward to sharing it with us. Paul, a little bit of your journey.
So I've been in the business, as you said, for 36 years. Started out actually as a cost accountant working at Standard Federal Bank. And I spent so much of my time focusing on how we could improve the efficiencies of the process with technology that in my last year, they actually moved me into the IT area so that I could start focusing on things across the company. And then moved from there to Flagstar. And over the course of my career, I've spent about 20 years at Flagstar through two different times being there. I've also worked at a couple of large IMBs, UWM and HomePoint.
Yeah.
And, through those times, I've seen a lot of technology changes, as well as a huge growth in the overall market.
Oh yeah, especially if you were there at UWM, and I was there when Matt's dad brought me in to consult to them early on, and they were doing, I think, 30-some million a month at that time. And then you look at where they're at now. So if you've been there any part of that growth journey, that's extraordinary just in that one experience, as well as HomePoint. I mean, a lot of growth. That's great.
When I joined UWM, they were doing about 2.5 billion. And when I left, they were doing about 20 billion. So
yeah. Tremendous growth. I want to get into talking about the Lender Price story, but I'm going to start with you, Dawar, because it really starts with solving a problem. And I suspect in the problem that you solved or seeking to solve, the genesis of your business was found. Talk to you. Tell us about it.
Yeah, so I mean, like part of the reason why we started building out the pricing engine, and mainly because during the time around 2015 is when we were founded, we looked across the various solutions out there, and we felt that number one, it lacked user experience. The overall user experience on the back end wasn't there. It was really difficult to add programs, manage margins, manage LLPAs, MSRs, etc. And we felt like there has to be a better way. There has to be an easier way. And since many of these technologies were built in the early 2000s, they incorporated the technologies that was available during that time. In 2015, you had a lot of open source. There was a focus on user experience, making things easier, automating things. And we felt that as engineers, me and my partner Lee Koo and his brother Lee Kao, we felt that we can actually make pricing on the back end much easier than what it was before. So we incorporated a lot of the new frameworks that was out there. I could remember a story. This is funny. So we were trying to figure out this parsing algorithm. And essentially, there's this MIT paper that talks about how you could parse data from any flat file. And I was at my kid's softball game, and then Lee Koo said, "Hey, I was able to reverse engineer the MIT paper. I can basically parse anything from any flat file." And I couldn't focus on my kids, my son Alexander's game. And then so my wife is like, nudging me going, "Hey, you're not focusing on the game here. What are you doing?" And I was like, "I got to get back to the office real quick." And then right there and then we knew we had something, because then shortly after we hired a very nice lady that used to work at Starbucks, and we added 50 rate sheets into our system.
Wow.
And she had no knowledge of mortgages or what it did. And she was able to do that in a month and a half. And so we knew we had something then.
Well, and you start out as a pricing engine. When did you add the underwriting component?
So the underwriting component is something that we're adding currently.
Okay.
So yeah, so we're finishing it up, and adding some last pieces, and we hope to introduce that in 2023.
Okay, very good. I hope we didn't talk about that prematurely here. It's just it was in the bio, so I thought I'd bring that up, because I've always known you as a pricing engine. I was unaware of the underwriting component, and so it's encouraging to see how technology and technology companies grow in their services. Paul, I had a couple questions about that, but I realize I'm jumping ahead. So Mark, we'll go ahead and edit this out. Where I was about to go, but Mark, I'll let you jump on with question number 3.
All right, gentlemen, I'd like to hear a little bit more about a quick overview of your solution and some of the customers you work with, but also along with that, I'd like to kind of hear what some of the trials and tribulations you've been through. I mean, you're dealing with a very technical aspect and very volatile aspect of our marketplace, and staying on top of that is got to wake up some days and be a nightmare as fast as things are changing in the industry today. So I'd like you to kind of address if you had to do anything special to deal with that in recent times and in past times.
Yeah, so we offer a product pricing and eligibility engine for retail, wholesale, and correspondent lenders out there. Obviously some of the challenges that you see recently is margin management. So how do you efficiently manage margins? How do you manage MSRs? How do you efficiently manage LLPAs? One of the things that we incorporated in our solution, and what we felt was needed, was to introduce a thing called NLP, natural language processing. Rather than using if-then logic, wouldn't it be nice, we said, if you could just write out a statement, and the statement, just a sentence, would it be able to read keywords and create the rule for you? So that's what we did. In terms of some of the customers, our technology is used by, more than 300 customers out there. We've got over 10,000 brokers in our solution right now. We're really proud of that, because just this last year, we had 5,000 new brokers that started using the solution. We've got some of the many of the mega brokers that use our solution day in, day out to figure out which wholesale lender has the best pricing. We've got 20 of the largest mortgage lenders, 22 of the top 30 wholesale lenders, and 4 of the top 12 commercial banks.
Wow, that's significant. Go ahead, Mark. Did you have anything else?
Yeah, well, that's interesting because, basically what you've done in gathering this information and presenting it, you've given a whole new market to a whole bunch of brokers that they didn't have before, because there's no way individual brokers could track all this stuff and be successful with it and do the comparisons.
And we
And you
offer
got
it for them for free. It's a free.
one-stop shopping. I like it.
Yeah. That's amazing. You offer that free to the wholesale, I mean, to the broker side of the wholesale industry. Is that correct? Did I hear you correctly?
That's correct. Yeah. Rather than double dipping, the wholesale lenders pay us to have their products and pricing in there, and then we offer it free. And that's why many of the mega, brokers out there have really gravitated toward it, because in a volatile market that we're in today, it's a great tool for them to use to see which lenders offer the best pricing, because it changes. Oftentimes you think that one lender offers the best pricing, and then you're surprised that someone else has got a new product or better pricing.
Yeah, I'm really interested in the NLP feature that you talked about, because that's a game changer for how it has been approached in the past. Talk a little bit more about that. Expand on that, if you would.
Well, the real reason why we created is because we said, okay, if then logic, math, all that stuff is kind of difficult, right? So if you get your if then wrong, if you get your your greater than and less than sign wrong, then you could possibly make a mistake. And that's where this MIT paper really helped us out, because being able to extract keywords, we're able to create the rule for the end user, and that's really what made the person that came from Starbucks, it made it really easy for her to add programs in the system.
I mean, that's an important point, because, the NLP does in fact take it to the point where the average person, or even someone with no knowledge, in that case, a Starbucks baristas type person coming in and be able to do that is pretty significant. I'm also relate to your story as an entrepreneur, being at a kid's game and getting some great news and getting nudged by your wife. I think I had that happen so many times when we were at a track meet or a basketball game for our daughters. So I kind of feel your pain. It's a signature of a true entrepreneur. You're just drawn. It's one of those things, you get pulled into your business all the time. And I applaud that. With volume down and rates higher, how should people be thinking about rates in the near term? And where can lenders find the opportunity in this challenging environment?
I think, rates have definitely climbed throughout the year for sure. But one really good thing is in the last 30 days, rates have actually come down about 100 basis points. So that's positive for the industry. And, hopefully those trends will continue as the overall economic environment for the country starts to hopefully stabilize a little bit. I think there's a lot of business still out in the marketplace, and I think people just need to start looking at it differently. When you're in a refinance boom, loans are coming in your door, without even thinking about it. When you're in this kind of a marketplace, that's the time where you have to sit back and say, where are the niches that we can focus on, whether they're professional loans, some of the new non-QM products. It's also a great time to train your loan officers on some of the specialty products that are out there that, again, during the boom of the refinance, they're churning through as many loans as they can, and they're not really studying as many of the options, the outliers that are there to help some of the lower income people. And this is an opportunity where you can really take a look at that and build up your knowledge now, so that when rates turn, you have a bigger audience that you can gravitate towards.
That's a really good point. Yeah, go ahead.
I've got a little story on that, and it just goes to what Paul just said. I was at a dad's event at my kid's school, and then so I was talking to a couple of loan originators, and they were talking about how they've never done non-QM before, but they said that these non-QM lenders are so great at helping them, training them, and educating them, and letting them know exactly how to structure those loans. So if you're a loan originator out there, and if you don't know, many of these non-QM lenders have a good training program, and they'll walk you through the process.
That's a great point.
Go ahead. I was going to say, the other thing that this time is good for is taking a look at your technology and making an investment that will help you put more efficiency in the process and make it easier, not only for your internal customers, but for the end borrower, making it as easy as possible so that they can get a loan in the shortest amount of time and with the least amount of grief.
It's good. I was going to interject a question there, Mark, but I looked down, I go, some of the questions I have coming up out of me are already a little bit down the line here. So go ahead, Mark. I'll let you go.
Well, I want to follow up with David on your question a little bit. Gentlemen, I work around niche markets myself, a lot of work with energy lending and also reverse mortgages, and I'm very proficient in reverse mortgages. Do you have any reverse mortgage pricing from the wholesale lenders on your model?
Yeah, that's a good question. Actually, we are working with I'm sure you guys have heard of the new solution Nova.
Mhm.
And
Yeah.
they actually are part of the organization that bought, I think, called Reverse Vision. Reverse,
Yes.
yeah,
Reverse vision, yes.
Constellation.
Constellation, exactly, Constellation.
Yes.
So, we did strike a deal with them where we're the pricing engine in their platform, and we are going to be incorporating some reverse lending products as pricing.
That's super. Mhm. That's great. Because there's not been a solution for that in the industry, and so I'm glad you're taking a look at it. Well, let me just ask this question in general. If you were looking at your product from 1,000 feet and you're thinking about how can lenders and originators best leverage your pricing engine to help drive their business?
Yeah, I mean, there's several ways. One, on the UI side, we have a configurable UI. So for lenders that want to incorporate non-QM loans and they want to incorporate home equity into like one user interface, so that way the solution can provide information that they wouldn't have been able to get if you were to use a static pricing engine that just got, a UI that does not allow you to kind of that doesn't give you insight into non-QM or HELOCs. So that's one way, is that our solution does provide this configurable UI where you can augment and add new programs in and also adjust the UI so that way you have the proper inputs for non-QM and home equity. And on the back end, it's really, how do you manage these programs efficiently? How do you provide a product that's quick to market so that you're the one that's out there offering that market, the product first before your competitor? Oftentimes when you do that, you become the lender that, if it's on the wholesale side, that brokers start gravitating towards. So being first to market is really important. And then, so as long as you've got your process and you've got your customer service in line, you're going to capture a lot of business. So being first to market and having a solution that allows you to do that quickly is really important from a pricing engine perspective.
And I think if you look at Lender Price as just a pricing engine, I think you're missing the point there. It's not just an electronic rate sheet. It has a lot of robust functionality built into it to allow the loan officers to communicate with their clients up front, giving them a wide range of options right from the start. There's the ability within the system to be able to take and compare products and then create a PDF that could be sent out to your borrower that shows side by side what each of the products are that they're looking at and what the parameters are of that. Communication is key when you're working with customers. And if you're not able to provide that information that's reliable and easy to understand, those are the people that you're going to lose, because one of your competitors is going to be able to do that. And with Lender Price, you have, to some degree, a marketing tool available to you that you can take and create that information right from the system and send it out. So that helps the process from a loan officer perspective. And, the easier you can make the process for everyone along the line, the better it's going to be. The other thing is when you look at the environment and everybody is trying to get business, any way they can, secondary marketing is the one that everybody's coming to saying, I need to give a special price on this loan. I need a special price on that loan. And Lender Price has built within their system the ability to have a workflow model that tracks all of that activity and presents it to the right person at the right time. Today, it's typically done by email or a phone call, and then it's days to get back with you. Based on parameters built into the system, you can have it set up to evaluate the request for a pricing adjustment, and given, you know, a branch manager's authority, it can automatically approve that. And otherwise, it'll send it on to the secondary desk, where again, they have a queue that they can look at and be able to track what's going on. So by utilizing that tool, you're improving the efficiency of the rate adjustment process. And, you know, again, key is you're reducing the amount of time it takes to get back to your client and tell them, you know, that you have a better deal for them.
Well, it seems like to me, you gentlemen have developed something that's really intuitive, and we needed that for a long time in the industry. But I think the fascinating thing about what you just went over is the interactiveness of what you're doing, because
Yeah.
the example you just laid out is one that's kind of plagued the industry for a long time, and there's not been a consolidated viewpoint to look at it and explore those numbers internally with the right people to make the right decisions. And I think you've really kind of handed lenders something that they've needed for a long time. And if it executes the way you talked about, it's kind of very, very innovative for them, and it's going to allow them to move on faster and make sure they get their deals done. And that's important in these times, because you don't want to fiddle around and lose a deal. So it's very important. So I think that's outstanding.
Yeah, I'm interested in something you were talking about is the marketing tools, the tools for educating consumers that you bring to the loan officers, especially in the non-QM part. The fact that you have within your system, in addition to what the non-QM lenders are offering, like Dawar, you saw many of them are willing to train the loan officers. But in addition to that, you have some of those elements in the system. I want to expand on that. And I want to expand also on what are you doing on the marketing side, because that is really could be that could pay for this. It's this thing. Of course, it's free to them. So but it's a real powerful tool.
Yeah, it's a good question. So in this new version of our pricing engine, what we've done is that we've taken the traditional pricing engine, you put loan inputs and you get your results. This next version that we rolled out a little while ago, it allows a loan originator to identify their loan inputs, you know, loan amount, value, FICO, etc. But it doesn't just provide them with just results. It also says, okay, here is your QM results, but you haven't really identified doc types, as doc types is an issue. Why don't you, there's some other options here on the non-QM side that might be advantageous to you, because maybe you have, you know, the loan amount is there, the FICO score, the FICO score is there, and, you know, all the normal loan inputs are there, but you have a problem with doc type. You can't provide 2 years W-2. You have to go 24 months bank statements. So our system intelligently guides them through that and says, hey, if you're having a problem with this, you may want to look at this other product that might help you close this deal.
When you look at the non-QM and non-agency markets, they're certainly heating up, and we're watching more and more lenders considering these products, but there's always the concern about liquidity when it comes to these non-agency products. How confident are you about liquidity, and how about the alternative aspects of this?
Paul, do you want to take that?
So, you know, non-QM is obviously something that a lot of people hear non-QM and they think, oh, 2008 mortgage meltdown, everything was non-QM, and it's really not the same marketplace today.
That's an important distinction.
Yeah, a lot of the non-QM products today are looking at small parameters that are outside of the QM space. So either higher loan limits, looking at things such as, you know, as Dawar was pointing out, the 24-month bank statement, you know, looking at bank statement loans, looking at professional loans, looking at different types of products that meet a niche market that isn't served by the QM space. You know, is it as liquid as, you know, the traditional QM? No, but again, the larger lenders that are out there creating these are looking to put them some of them are putting them on balance sheet, and then others are securitizing them and selling them out on the marketplace. And I think as they get the information out that, this isn't a CISA loan where it's stated income, stated asset, it's a traditional loan underwritten against the same parameters that a QM loan would be underwritten against, but there's just a few nuances around it. Again, I would agree, the investment community is not going to be looking to do non-QM to the extent of CISA. Nobody wants to get back to those days, but I don't think that, it's closed its mind down to the non-QM space in its entirety.
And my take is this, is like lenders can certainly profit from non-QM loans, but I think there are a few things to keep in mind. First, I think non-QM tends to come with a higher interest rate than traditional mortgage loans, right? And this is mainly because they're considered to be higher risk for lenders. And additionally, non-QM loans may be more difficult to sell in the secondary market, so the lender may have to hold on to them for a longer period of time. But all this said, there's definitely money to be made in the non-QM lending space. It's not like the former subprime. And lenders who are able to navigate these waters successfully can make a lot of money.
And another point is that even in the QM space, there's options that are coming out that are meant to save individuals time and money. So title insurance is one of the areas that traditionally takes a long time to get through the pipe. The agencies, Fannie Mae and Freddie Mac, are now buying loans with an attorney opinion letter. We're calling it alternative title. So an attorney reviews the property, and again, they have to fit within certain guidelines that Fannie and Freddie are offering. But it is an option, especially in the case of a refinance. It's a great option to save a lot of money to the borrowers and a lot of time overall. The agencies are also looking at their models and really focusing on how they can improve their waivers for appraisals. And again, the more the industry continues to move in those directions, the easier it's going to be not only for the borrowers, but the loan officers and lenders themselves. I think anyone that has been in this industry for a long time knows that the mortgage industry's number one thing is it changes on a daily basis. And so those people who are focusing on that change and looking for ways to incorporate it into their systems, those are the ones that are going to be able to move forward faster. And those are the things that Lender Price is looking at and trying to figure out, how do we make that available to our customers so that way they can serve their customers even better.
So I want to double down on the question about the liquidity. I want to make certain that everyone hears your point. There is less and less concern about liquidity issues because of the nature of this product in this cycle. So I heard you say that, Paul, but I'd like to get you both, the doubling down on what we're talking about there on the liquidity issue, because that has been a recent conversation to several lenders that I'm talking about that are looking at this and go, but my concern is the liquidity. We watched what happened the last time. I can't be holding loans on a pipeline on my warehouse line where there are liquidity issues, or if they're a broker, have a borrower in that program only to have to explain why it's disappeared.
I mean, I think when you're looking at a non-QM loan and being concerned about liquidity is, a legitimate concern. You have to look at, the lender that's offering that non-QM product and how stable that company is. Not every non-QM product out there is going to be the one that you're going to want to jump on the bandwagon. You as the broker, as the lender, need to be doing your research as well to see who's backing this today and how are they taking it to the street for final sale. It is, again, as Dawar said, non-QM typically comes with a higher interest rate because there is more research that you have to do in order to succeed. Again, is it as liquid as it was in 2008? No, but we learned what happened in 2008 when it was significantly liquid. loans were being originated that shouldn't have been, and products were being offered that really shouldn't have been.
Yeah, and there's liquidity and there was stupidity. We were on the stupidity of the side of the business for that. That's for sure. Back in those days, the old fog the mirror and sign here kind of concept. So no, that's really good. And the liquidity I'm referring to is once the loan is funded, is there an end source to it? Because I think of it as a mortgage banker, and it's that liquidity risk of loan sale, which is after the loan is funded. That's the one that I remember going through some real gut wrenching times when I had my last mortgage company.
And again, knowing who you're selling that to
That's
as
such
you're
a good
starting
point.
the process, that's what you really have to investigate before you jump into that non-QM product.
Paul, it's spoken from a lot of wisdom from that perspective. I can't stress. Dawar, did you have anything? You were adding something to that?
No, I think Paul covered it best.
Yeah, good.
Well, I think it's fascinating about the non-QM. This current market we in tends to give a surge to non-QM, and having that information is much more readily available through lender price to folks is a big plus, because as you talked about the industry changing radically and on a dime, non-QM can move faster than about anything out there. And so having the access to a system that helps you with that process is just outstanding. But I'd like to move on a little bit, and I'd like you to put your, Paul and Dawar, I'd like you to put your marketing hats on right now. So if you're out there right today and you're dealing with what you're dealing with, and you'd say, I want to sell my system to you to use, what makes you better than other folks out there, or what makes you the best that's out there? And I think I know some of the things you're going to say based on what you said already about being innovative and stay on top of things and all that. But if you had your marketing hats on, you're talking to a potential customer. What's the few sentences that are key sentences you use in that conversation?
So, so obviously we have a modern pricing engine, right? So there's a lot of benefits that come with that. We've got a modern tech stack. When it comes to security, that's important. When it comes to, tech debt, making sure that you're, offering a great user experience, that's important. The difficulty of managing loan programs on the back end is something that you've got to take into deep consideration. How flexible and adaptable your APIs are, because now the industry is really into integrating with each other. So we have a very robust API. Our application is an API-driven app. So anything that our application does, we can expose it through an API if it hasn't already been exposed. That gives us a lot of flexibility when it comes to us integrating with other solutions out there. And then the other thing too is because we have a modern, we're using all these modern frameworks and stuff. If there's something that a customer wants or was thinking of that they couldn't do before, we're very open to listening to that and saying, okay, well, help me understand that more. We obviously check with other lenders to see if they want that feature or functionality. And if they do, then we incorporate it. And that's what's made our product so much better, is that we listen to our customers, and it's grown based off of our customers' feedback. A good example of that was Paul, and about all the various ideas from price interpolation, rate interpolation, worst case pricing, various ways of how you handle that. We think that we do a much more efficient, we make it much easier and make it much more efficient from a capital market side in terms of how you manage and maintain that. But it's the overall technology. I think there is a changing of the guard. If you look at mortgage technology throughout the years, there was one LOS that was the most popular LOS, and then all of a sudden another one came, and offered something that's better. And I think that lenders are always looking at solutions that can help them be more efficient. And we think that we have the right solution.
I think one of the things that Dawar started to touch on is that Lender Price is an independently owned company, well capitalized and able to move in an agile fashion. There isn't this hierarchy of 30 layers of bureaucracy that you have to go through in order to make decisions. Lender Price can look at a product, look at a change, and make decisions very rapidly to say, yes, this is going to help us, and we need to move forward and make that happen. stability is another thing that, puts them apart. Because of the architecture that they have, it's all built on microservices, small microservices that they can deploy both wide and high and throughout the country. So they operate both in the east and west regions of AWS. So that way, again, if something happens in the west, their customers aren't impacted because we've got the east region. And again, they're constantly monitoring the performance of the application. And because of how it was built, they're able to scale up to meet the demand and scale back down in order to keep price or cost as low as possible. They offer both multi-tenant as well as individual tenants. So again, you can choose how you want to arrange the system. And I think it's important to note that because they have so many different customers in their system, they're able to make it easy for you as a lender. If you say, hey, I want to use that company's product and offer it to my people, it's not a matter of going and building all these integrations. It's, hey, we're going to now host that product in our rate set. Because, the way the system is architected and operates, you have that ability to build relationships, not just with your customers, but with the other lenders that are on the platform as well. And that really makes a big difference. He touched on the APIs. And again, there are a lot of companies out there that say they have APIs in their systems, but their foundation is client server. And Lender Price's foundation is APIs from the bottom up. And it's not just APIs used to communicate with lender systems. Their front end communicates to their back end using those same exact APIs. So that flexibility, really provides, the ability to change the system whenever you need. And again, the marketplace that they offer is having significantly better success rates than its competitor. And brokers are starting to realize that and see the benefit, which is why, as Dawar mentioned, throughout 2022, they were able to acquire a couple of the largest broker networks out there to start using the application.
Significant. When you're looking at the overall industry, you must have a unique perspective from the place that you sit in the industry. And I would love to get some of your thought as to what you envision the mortgage industry will look like in a couple of years out from now. And how does the market relate to past down cycles? I mean, I'm thinking of our current market and the current down cycle we're in. How does this current one relate to previous down cycles? And what is some positive advice you could share with some of our listening audience about some of the more positive things we have to look forward to? Hopefully there's something more positive out there. We know this is a cyclical business, so it's fair to assume we're going to see some brighter days again.
So, I mean, I think that, how do we envision the mortgage industry will look like in the next couple of years? So lenders are obviously, I just got off the phone with just one mega lender right now. And they're assessing their technology capabilities, and they're determining how to use both what they already have and what they will need in the new world of digital lending. They want to be able to provide a better customer service, faster decisions, and more streamlined processes. However, they also need to make sure that their systems are secure and compliant with the latest regulations. So lenders that can execute loans quickly and accurately will be able to charge higher margins, as borrowers will be more likely to choose them over their competitors. And by digitizing the loan manufacturing process, lenders can speed up the turnaround time for borrowers and improve efficiencies and accuracy. And I think that, as you incorporate data analytics into this, you can make more accurate credit decisions and increase margins on loans. I think lenders that use modern solutions out there and who are not should be looking at that during this, this lull. Right now, it's not what, the volume is not what it was in 2020, 21. this is a time that they should be looking at their technology stack and figuring out, what they can add, what they can replace, what they could keep.
Yeah, I would agree with that comment. The down cycle allows you the opportunity to right-size your company and make sure that you've got the brightest and best people working on your applications. It's been tough for a lot of people in the industry as companies have either gone out of business or downsized significantly. But those lenders that are still pushing forward, I think are now at the point where they can see that they're leveling off and look to utilize the team that they have to improve their overall processes. One of the hardest things to do during a boom time is to find business and individuals who have the ability to work with the technical teams to make those large changes and important technology enhancements to their system. Now is the time to take a few of those business teams and marry them up with the technology teams and take advantage of this time to build your efficiencies now and to invest in the technologies that Dawar was referencing earlier. Make sure that your tech stack puts you in the position so that when the market turns, and we all know in the mortgage business, the market doesn't turn over the course of 10 years. It turns over the course of 2 months. And when that happens, you need to be able to turn that spigot on and get those loans flowing. And if you have the technology that's, one, easy to learn, and two, provides high value without having to provide the need to hire, a significant number of people to make it work, those are the people that are going to survive and thrive even better, not only now, but during those boom times as well. So, the natural language processing that Dawar was talking about, that's what allows you to be able to take technology out of the technologist's hands and put it in the hands of the business team. For them to be able to hire people that can just type normal sentences into a system and have it come out with the rules that we have. Those are the teams that are going to be able to make changes on the fly and make them quicker than others, because again, they're not reliant upon technologists who are the ones who are typically writing the if then else statements that other systems require.
I can't stress how, for those that are not familiar with NLP, you need to become familiar with it and what a game changer that can be when it comes to how the queries are made. So I think it's really significant. Are you seeing any trends towards wholesale where you're seeing more and more people setting up broker shops? Are we seeing that sector grow, Dawar?
Absolutely. And speaking with the mega brokers that are using our solution, they're in this market right now. What they're seeing is their employee count increase. And partly it may be because some of these retail lenders are laying off some of these originators, but a good portion of them are realizing that they can get better rates. Now there's a trade-off. I'm not saying that one is better than the other, but I am saying that if you're a loan originator that has your own pipeline of business, then the wholesale, then becoming a broker might be the best option. If you look at pricing as it relates to retail, wholesale, and correspondent, there's a difference in terms of pricing and how it's offered because of the cost effect. Right. Employing a retail loan officer, it costs more than just a broker. A broker is just pure 100% commission. So you often make more money off of the loans that you're broken to wholesale lenders. So it's one of those things like, do you have your book of business? But what we are seeing with the mega brokers is that they are increasing during this time in terms of their employee count.
And we're seeing a trend towards the TPO. It seems like a lot of growth, and there's a lot of even mortgage bankers. They're looking at. I'm thinking of UWM's pricing. That's your old employer, Paul, who has really been pricing extremely aggressively. It seems like through the floor. And it's giving reason for a lot of people to go, why am I trying to be a banker when I can get this kind of price over at UWM? And if the mortgage companies are thinking about it, certainly the loan officers are thinking about it. So why do I stay at this company when I get so much more aggressive pricing? Now that's a short-term thing. I don't anticipate they're going to continue to price like that inevitably. I mean, forever, but inevitably it's going to be going back to something where they'll be more in line with the rest of the market. But that certainly has got to be a contributing factor. And your system has got to point that out to them, making it glaringly obvious to them.
It really does, with the Marketplace app, it does provide them the ability to shop and see what the rates are. It is, I would agree with you that it is a short-term situation that is happening right now. But I think what it does for them is it provides an opportunity to introduce themselves to other people along the way. You asked about the mortgage industry and where we see it going. One other thing that people should be looking at right now is making sure that their retention policies for mortgages that they service are set up correctly. And that's one area that we didn't touch on that Lender Price provides a huge service for. We have one lender who is running about 9 million loans through the system every day, looking to see, are any of these loans in jeopardy of running off?
Yeah, about 9 million. They have 9 million a day. Did you? A day. Wow. And that's taking service. That's got to be a servicer who's taking loans that in their portfolio and analyzing it. Am I you correctly?
Yes, you are looking at that correctly. And what the system does is it runs through and it says, here's, based on the information that you've sent us, here's what current pricing would be for this loan. And again, they're targeting loans in their servicing book that could potentially be candidates. And this way, when a customer service agent is either reaching out or a customer is reaching out to the customer service agent, they can see that information in their system and say, hey, by the way, I want to let you know, we really think we could save you some money by lowering your interest rate. And here's what your new interest rate would be. Companies that are focusing on that right now are really setting themselves up for, again, when rates change, one of the most expensive things to a servicer. So if you're an originator and a servicer, is that runoff of your servicing book. And if you're constantly looking at that book, pricing it out, looking to see where are my opportunities, not to just originate a new loan, but to retain that servicing, which is, again, you originate, you get the short-term gain right there, you service it, you're getting income flow over the course of 5, 7, 10, even 30 years for people who, find the right rate and the right company to do business with.
And Mark, as a servicing guru yourself, you start realizing some of the benefits of technology like this. Your thoughts on that?
Well, I think it's excellent. It's something that people have struggled with, and you're offering a potential consolidated solution. I mean, I can use a ton of words to describe what you really have done here, and I think the timing couldn't have been better, considering what's happening in non-QM. We talked about that. I love the idea that you think about doing something on reverse, and certainly portfolio retention has been a big thing for me and a lot of people in the industry whole life, and nobody's really ever done a great job at it. And I think you're going to give them a tool where they can do a great job at it. So I think that's a real plus thing for the industry, and it's a plus thing for everybody because it's a plus thing for the borrower too. It's not a thing that has a big moving target in front of a borrower where they feel like they got to go 28 places when their existing lender can reach out to them and say, I have a solution for you. That's a big deal. And I like that.
Well, I look at also a couple other issues that I'm wondering if you solve is the fair lending issues. A big issue that came up in the last housing cycle is why to the loan officer, and companies, mortgage brokers got really maligned with this, I think unfairly, but they said you put someone in a subprime loan, you could have put them in a conventional loan, and it's the steering that goes into this. How does your system, or does your system address any of that to really help them manage fair lending risk?
Yeah, so we do have a QC piece that if they do violate anything like, QM or HPML or something like that, it does trigger and let the originator know that you're violating that rule. So we have that capability.
I think the other thing is that it provides them all the options. It doesn't just come back and say, here's the one product that you
Right.
can choose.
That's right.
It
Yeah,
comes
that's
back
really
and
good.
says, across the entire spectrum of products available to you, here are all the products, and here is, the best pricing that you can get on those products.
That's what I want people to hear, because it's not, I think we get tunnel vision, or we get sometimes a loan officer or originator gets a tendency to sell one product. It's the product they know really well, and they don't consider the other broad range of products. So when you have a tool like yours, they have the ability to see all the products they might not have otherwise thought of and go, wait a minute, I may not be an expert in this, but this is actually a better product for the consumer. So it does help manage and mitigate fair lending risk. It's very encouraging. We're out of time. Man, how fast the time does flow. I've got another call coming up here shortly, but I want to ask you, how can people learn more if they want to get in touch with you? What's the best way? I'm sure go to your website. So what is that?
Yeah, that's lenderprice.com. That's lenderprice.com.
And then if they want to get a hold of you, emails or phone numbers that they should be calling?
Yeah, they can contact us at sales@lenderprice.com or contact@lenderprice.com. And our phone number is 626-486-0171.
Good. Mark, thanks so much for joining me in the interview here with me today. It's a exciting product, Mark. I look at this and I see, thinking back in the days, you and I.
It's fascinating, David. And again, you're working with gentlemen like this and delivering some very timely information needed for the industry at just exactly the right time again. I mean,
And the best part is you get to know them, Mark. You find out how smart these guys are. I had the privilege of spending time with them at the conferences. They're good people. They got great knowledge, and they're just really smart. NLP, very cool. I'm very excited about that.
The smart guy in this room is, between me, it's Paul. Paul is a legend in this industry. He is the technology legend in the industry, and I have such great respect for him and everything that he's done in this industry. I wouldn't be surprised if he wins some great award for all the contributions that he's made.
That's great. Great compliment. Great compliment. And it's true. And it's really true. You got Kevin Costner on one end, you got Paul on the other, and you got Dawar in there with his genius on the tech.
We got to get Paul in one of Kevin's movies.
Yeah, we got that'd be great. Well, gentlemen, thank you so much for being here. It's really an honor to get to know you better and be able to talk about your products. Continued success in 2023. Can't wait to learn more about your underwriting engine. You have to come on when you're ready to release that and tell us more about it.
Would love to.
All right. Thank you so much.
You've been listening to Lykken on Lending, a weekly mortgage market update with your host, David Lykken of Transformational Mortgage Solutions. Join us next week, and thanks for listening.